Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. So on Monday, we kind of went on a tangent. We ended up actually buying some volatility long term. So we went out quite a bit in time and bought some call options in the VIX. Now, we can always roll that into a call spread at a later date, but the VVIX, the volatility of the options inside the VIX option chain, is way down. So not only do we have the VIX dropping precipitously below the 20 level, we've had the volatility index drop all the way up from about 190 down to today. It's up a little bit to 94. But when we put on the trade, the VVIX was at about 88. So that's way at the low end of the range. You can usually chart the VVIX if you want to look at that. I'm not going to pull that up today, but if you want to take a peek at it, feel free. And because vol was low on the volatility options, we went out as far as we could in time, and we looked at potentially buying two different call options that were a little bit out of the money. Bottom line is the uncertainty is still not removed. The fact that trade deals are happening is a good thing, and obviously the marketplace thinks it's a good thing because we've had a huge run up here over the last couple of days. We're starting to give a little bit back today, and actually we're flat at this point in time. But with that all said, I do not think that the volatility index, the VIX, should be below 20. There's still a lot of uncertainty in this marketplace. We don't even know the ramifications of all the shipping that got stopped because of the huge tariffs coming out of China. Right now, the deal looks like it's solid, but there's still stuff to find out. So I do think there's going to be way more volatility than what the VIX is saying. And for the first time ever, we actually looked at just buying call premium in the VIX index going out in time. So if you want to know more about that, look back on the Monday show. There's really nothing to report there. That trade's going to be on for quite some time. We also looked at Take-Two Interactive, and that stock today is at $228.23. It is up with the entire market. We wanted to buy a put on that option contract, so we went out to the 16th expiration. They are going to be announcing Thursday after the close, and we did say that we're going to ride the put for a little bit and see if we could get out of the position, hopefully get a down move in the marketplace. That didn't happen. So we're going to roll that position into a bear put spread. In other words, a put debit spread is another way that you could say that. But we set this trade up the way that we did on purpose, right? So let's go look at the chart on Take-Two. TTWO is the symbol. So we really, we haven't done much at all over the last few days, and actually you could call it some chop for Take-Two. We had a huge down move here, so we're kind of trading right in the middle of that gap, actually. Just kind of dancing around right there. We got the 200-day, the 50-day, all below this level right now. So we got some strength in the marketplace, but definitely an overbought situation. Let's go out about 1,000 days. And it's just, the stock's just getting a little pricey. And any small miss, I think, could really hurt the underlying stock. But if you look at this, like, you wouldn't want to have to climb that hill, right? That is pretty nasty. But we could go all the way down to 190, fill this gap that's right here. That's got that potential in that type of move. I really wanted to just get long a put going into the trade, but it's too expensive. We paid $9.70 for the 230 strike put. So let's go back. We're doing a very short term May 16th expiration. We bought the 230 strike put, and we are down about $1.70 on that trade. So let's grab this one. There it is. 516, 230. Yep, that's right. And so now what we want to do is, and let me give you a little preference behind this, okay? I get comments all the time about explaining the thought that's behind the trade. Now, on Take Two Interactive, when you got a stock that has been up with literally weak fundamentals, right? High PE ratios, and not it's a very interesting company, and it's in the software world, which kind of helps with the trade more a little bit. But with all that said, it's a very volatile underlying, and it's mainly because, well, here even inside the Tradier platform, we're showing the PE ratio just being outrageous, and because of that, if there's a tiny miss on earnings or things just don't turn out, they really need to beat and exceed on the earnings front. I like to buy the put option in general going into the earnings, because if the market does go down, first of all, you have earnings, which will pump up the implied volatility. And then if the market's actually going down, that can actually elevate the volatility a little bit more. So we did this on Monday. I would have maybe liked to have done it last week. It wouldn't have worked out in this case, but I'd like to get about a week out or so, buy a put option as we get closer to the earnings. If it's not working out, sell another put against it. So to try to offset a little bit of the loss that we've had on Take Two so far is to, like, say we bought a put option. If we were out here, we would have had that opportunity with the big downturn, and then the markets came back, and now it's just been chopped, basically just trading flat, waiting for that earnings report. But you could see where you would have that opportunity, buy the put out here, get to move up, comes back down, comes slamming down, bounces. It looks like it bounces off the 20-day a little bit, and then goes back up. So in this instance, you would get out ahead of the earnings. Now, we did it a couple of days ago, paid up for the put, thought implied volatility would go up, and it has. Implied volatility has increased. It kind of buffered the fact that we were wrong about the direction. It's up $2.57 on the day. And now we got a hedge. We can go in and sell some volatility premium and ride it through the earnings. I'd rather have the profit before the earnings. That would be the ideal situation. But I really like this scenario where you have a company that's way overvalued, that's going to be a little bit, that's has to do well during earnings in order to keep the frothiness that's in the stock. And if they just have a little bit of a miss, well, then you're got some potential downside. You ride it into earnings as a long put. You get up to earnings. If things don't work out, you sell a put against it, and you roll into a bear put spread. So here's where our trade is at. Here's the 230 strike, and it's trading for 775 on the midpoint. We put it together at 970. Ouch, that hurts a little bit. So we're down $2 on the trade. And now let's try to get some of that premium back. So let's sell this one for $2. We're going to sell the 2017 50 strike. Yeah, that gives us about 10 points. So let's sell that. And what will happen then is we'll lower our cost basis. Okay, so this is the put that we're in. We're going to, so if we're long the Take Two position, and I'm going to grab this graphic, I'm going to zoom in on it. And this is the paper trade and the graphic that I took showing the Take Two position. Limit price was $970 when it was purchased, $970 per one put option that you bought. That's your max risk. We now look at the stock. Where was the stock at this day? $225. It was actually down on the day. $225.19. We are now at $228.53. And it is trading for $745 at the mid. We are going to go out, and that position is on, right? Consider that position on in your account. So the adjustment trade today would be sell this. So basically the amount that we're down, we're going to sell this and bring in that premium. We now have a 10-point wide spread. We have the potential, if the news is bad, to make up the loss and then some and still be profitable on the trade. I like this scenario. It gives you a couple of chances where you can win on a trade that you think of stock, especially when you think stock is frothy. And ideally, going into this market, normally you would like the fact that just the news could bring the underlying down. But what has happened is the news actually brought the whole market up, and Take-Two Interactive went right along with it, it looks like. All right. So if you have any questions on that trade, please feel free to put them in the chat box. We're happy to make this an interactive session, as interactive as possible. So I do see, oh, there is a comment. Okay. Right now, the Take-Two 560, I'm seeing a huge spread between the 230 bid and ask. Yeah, but I do think that you could fill it. Right now I don't have volume in here, but the fact that you're going into it ahead of earnings, if you're going into it ahead of earnings, I do think that you can get a fill closer to the midpoint on that trade, mainly because volume is probably up. We got open interest right now on the 230 at 386, but we're heading into an earnings report. So my comment would be, Anthony, is that I would still try to fill at a midpoint. Now, if you did it as a spread, you would have probably a really solid chance of filling at the midpoint. But if you do put your order in and it's 660 by 830, you will see the bid-ask spread move on that position. You will see either the bid move up or the ask move up. And we're heading into that earnings report. I would think you got a pretty good chance of filling on that underlying. This is where most of the open interest is at. That's at the 225 strike, 2,125. And that's still a little bit wide for the highest open interest option contract. But there's no good. So to put a cap on it, there's no good way to deal with wide bid-ask spreads. There's no magical solution to make the market makers fill the trade. You want some decent open interest. You want some decent volume. Trading around earnings is usually a benefit without a doubt because everybody's looking at it. But I would say you have to work the order. And if you don't get it, you just let it go. If you put in an order and it doesn't fill at your price, don't end up paying the ask. Don't end up paying $2. Like right now, we're talking almost $2 on on that option contract. So I'd work it at the middle price. And if you did this all as a spread, you'd be better off. But now we're legging into it. And that's probably one of the detriments of what I just said. You're buying an option outright and then you're selling an option outright as opposed to bringing it to the floor as a spread. And in this instance, that is a detriment, without a doubt. All right. The next trade that I want to look at is in Zoom. Zoom's going to be announcing earnings here. Zoom will be announcing next week. So in Zoom, it's the exact opposite chart. So I thought I would throw this together just to try to compare apples to apples. Well, fundamentally, Zoom is trading at a much better ratio, much better market. Market has been beaten up. We're at a precipice right here at the $84 level. And I think it could go higher. So we're going to use the same strategy. And what we're going to do in Zoom is we're going to buy a call option outright. And we're going to use the earnings. We're going to go out to the May 9th. As a matter of fact, I'm going to go a little bit longer in this instance. We're going to buy the May 6th or the May 23rd. I'm going to buy the May 30th, 16 days out. And we're going to go a little bit into money. And once again, this is just a paper trade. We're going to have some wide bid-ask spreads because it's Zoom. It's about the same liquidity as Take-Two, I would guess. Applied volatilities are a lot lower and anticipate that they are going to go up. in this instance. And we're going to buy, let's try the 80 strike call. What's the delta on that? 66. We're going to pay 585 for this trade. Yeah, there we go. And this is the position that we're going to put on heading into earnings. And we'll do the same thing. If the momentum to the upside continues in Zoom, Zoom is trading at a decent valuation compared to the competitors in the market. And we've had some solid upside. Once again, trade war is not as big of an issue with a software company or website company or meeting company, however you want to say it. And if we do that, the earnings are 5/21/24, and it's going to be after the close. So let me grab that date. Oops. So 5/21 is going to be the Wednesday. So we're exactly 7 days away. So that would be the ideal scenario. Anywhere from 7 to 10 days. Because you're buying volatility, you're anticipating volatility will go up, which would soften the loss. But especially in that last week to expiration is when you kind of see the volatility start to creep up more so than any other week, right? That last week to that earnings report is when you start seeing volatility creep. So right now we have the implied volatility at 70%. The 30-day is at 54%. The normal volatility is around 40%. Would anticipate that vols will go up. So if you're wrong on your forecast and the market does go down heading into the earnings, implied volatility might creep up and help recover on the trade. If the stock goes up, we're just going to sell it. If we could make it a dollar or two and get rid of the risk of the earnings, we'll do that. No problem. If it doesn't, any losses that we have, we'll try selling a call against the position and trying to make up for the losses like we just did in Take Two Interactive. So here's our paper trade for the next 10 days going out to the 21st. 21st after the market close, double checking that. So that is when the earnings report is going to be. We're going to go long a Zoom call option riding into the earnings, and we're going to do the opposite that we did in Take Two, and we're going to get bullish on Zoom heading into their earnings report. All right, let me check questions one last time. We have the same situation in Zoom in that we got a little bit wider bid-ask spread. It's not as ugly as Take Two. We're 20 cents wide on this. I still think that you could execute somewhere close to the midpoint, at least at 585. We would be fine. Open interest is actually lower on this one than it was in Take Two, which is interesting. But it's obviously not even close to the volatility, 55% vol versus 100 and something in Take Two. And then, there's our earnings. Any questions on that? All right. So overall on the market, the VIX trade, when the VIX ran up, we got short, did fairly good on that trade. When now the VIX is down, and I'm surprised to see it below 20. Like I mentioned on Monday's show, it took forever, even though there was obviously a different market, but it just took forever for the VIX to get below 20. And it's more so just that there was just a lot of uncertainty about a lot of things. And I still feel like we have uncertain times. News headlines are really driving the market more so than earnings even. A lot of companies are still not giving forecasts after their earnings report. So there's still nervousness in the marketplace. Very surprised to see the VIX at 18. And more importantly, surprised to see the volatility of the options in the VIX index below 100, the VVIX. And so we bought some premium, and we will do the same scenario that we have here. If we get closer to the expiration date and the market's not going up, we'll sell a call against our long call position and generate some income by creating a bull call spread, which is bearish in the VIX index, right? Buying long call spreads is a bearish move. It's the VIX goes the opposite direction of the marketplace. So that's it. All right, everyone, a little bit short today. We'll give you some time back. My name is Brian Overby, known as the Options Guy. Please let your friends and family know about Options Guy TV inside the Tradier Hub. And if you haven't yet set up a profile, go to hub.tradier.com. You'll have easy access to all of the speakers. It's free to do. And support the program. We appreciate it. We'll see you this Friday for the next edition of Options Guy TV. And we'll see where Take Two Interactive ends up. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.